certainly with not only the president now, but Navarro and everyone else jumping on. But I think the Fed needs to just stay its course. It's got to shut that noise out, as difficult as it may be, right? I was never one. I didn't think we needed the rate cut we got. I didn't think we needed it, but the market was going to throw a temper tantrum if it didn't get it, and the market's going to throw a temper tantrum if it doesn't get the next one. So I think he's almost forced into having to do it, besides the fact that central banks around the world are doing it, so therefore you got to kind of stay in line. But I'm not one of these guys that says we need a 100 basis point cut at all. Another 25 basis point, in my opinion, would be max.
You think that should be enough?
I think that should be more than enough. Because, look, the economy's great. The consumer is great. The macro data is fine. So what are we cutting for? We're pushing on a string.
And you think he can bring the market around to that point of view?
Well, wait a minute. Is it his response? Who? Fed Jay Powell?
Yeah.
Is it Jay Powell's responsibility to do that? Since when was the Fed responsible for the market action? But the investors and traders and asset managers need to price the market. What's the risk? And so they will price it. It's not the Fed's responsibility to price the market, nor is it the ECB's or the Bank of Japan or the People's Bank of China. None of it.
Even though you have all this other stuff going on, as you say, trade, geopolitical stuff, what if you just make it as simple as Mark Mobius is saying? You have a race to the bottom with central banks around the world. Stocks will go up in that environment.
Because they have to, because where else you go? Again, it's the same great financial crisis event, right? When rates went to zero or even negative, stocks went from 666 on the S&P to 3,000, right, over the course of the last decade.
Would you agree with him, that premise?
Well, where else are you going to, when rates are zero, where else are you going to go? There is not any other place to go, which is why I think that's a problem, because when rates even start to normalize a little bit, and we get only to 2.5 or 2 3/4, and they were throwing a hissy fit.
Right.
If we got to 3%, in my mind, I think it's completely misaligned. I think the rates need to be normal. I don't think zero is normal.
That's for sure. There's the opening bell. Kenny, stay with us. Let's get S&P 500 at the CNBC Real-Time Exchange. And the big board commercial mortgage lending company Ladder Capital at the NASDAQ bank holding company Cross First Bank Shares. Speaking of banks, there's a great chart around this week. The spread between twos and Fed funds overlaid with small bank lending, right? If that spread doesn't close, banks will get tougher on lending to small business.
I think banks are going to get tougher on lending to small business, and I think banks are going to get tougher on lending, quite honestly, in the mortgage space as well. I just think they're going to get tougher on lending because there's no meat in there.
You've had, the dynamic where these, the hunt for yield has been the story, right? Rates have been so low. Utilities and the staples, as Carl was saying to our prior guests, what are you going to buy? Hershey and Procter & Gamble and things like that. Are those the things that still are the way to go?
Well, so now what you have to look at is you have to look at value, but you have to look at dividend yield, right? What are some of these companies paying, right? 3, 4, 5, 6% yield. That's actually a good place to put your money when rates are zero, right? So you're going to start to look at some of those names that are strong dividend players, that are consistent dividend players, that have a nice yield, that maybe some of these names have created on top of the yield, they're creating great value.
Interesting to see Deere in the green at the open. They did miss at 271, looking for 285. Ag equipment down 6, overall equipment down 3. They cut their guide for the second consecutive quarter. They do cite tariff concerns and the obvious pressure on the farm economy.
Right.
But so a little, it's definitely holding in here at 140.
Well, it's holding in, but I guess you'd have to go look at it. I'd have to see the chart up close a little bit. But has it gotten so beaten up over the last week and a half that now it's at a point where buyers are seeing longer term value in it, and they're looking beyond today, tomorrow, and next week. Right? The big asset managers are finding value. That's what I'm talking about. Is that some of these names that have gotten unnecessarily beaten up because they're easy to sell because they're so liquid are now in a position to really benefit. And so if you're someone who's got the long-term view, or if you're an asset manager, if you're even an individual that's got 5, 10, 15 years out, days like this you love because it provides an opportunity.
Yeah, I wonder somewhat if, we're kind of blowing the opportunity to have a positive market as the summer comes to a close before you get seasonally tough.
Yeah, but August typically tends to be kind of a volatile month in general, but September and October do too as we move into the fall. And so you're right. I actually think, though, as we move into the end of the year, November and December again, I think that's when you're going to see kind of the market rally. I think you're going to have a rough couple of months. You're going to have this volatile thrashing around in the market for the next couple of months. And then I think into the end of the year, you're going to start to see some light. That's my guess.
Really?
That's what I think.
I mean, earnings earnings estimates for the full year have come in.
They're coming in.
We're now
big
looking
time.
minus 1.5.
Right.
In January, we thought it was going to be 6.
Okay.
So we think 2020 earnings are going to rebound?
2020 earnings, I think, well, when you say rebound to where?
I don't know. Back to flat? I mean, depends on where the
Yeah, because look, we had a negative forecast for this quarter that we're in. I think net in the end, they actually came in a little bit positive. Weren't they like up 1.5% versus down 0, down what they thought it was going to be? So yes, I think as we move into 2020, when you're going to see if we get a trade deal, and I still don't think we're going to get a trade deal certainly in the next couple of months. If we get one and we get any movement at all, it's going to be more towards the end of the year. Because look, he needs that narrative. We're going into the election cycle now. We're already in it, but 2020, he needs that narrative.
But no trade deal in the next few months. You're skeptical on earnings, but yet you think the market's going to go up by the end of the year.
It's not that I'm skeptical on earnings. I'm not. I think that earnings are going to stabilize. I'm not skeptical on them. I just think, look, I think like anything, initial estimates are always worse. You start to adjust as you get closer, and so I think we're going to see that adjustment happen as you start to move into the fourth quarter and then the first quarter of next year. I actually think the market's okay.
Semis certainly look good today. They're going to all ride NVIDIA, which is the #1 S&P here. You got Western Dig, Micron, AMD close behind. NVIDIA did beat 124, revenue ahead. These high-end video game chips, again, a big secular tech story.
Right, and now that Trump pulled back on those tariffs for Christmas because he's worried about the consumer, those tech names, which have gotten beaten up, are all going to benefit, right? And then, as we get close to Christmas on the 15th, and the threat of reimposing those tariffs is going to cause a turmoil again. But in fact, I don't think that, I think by then we'll have solved that part of the problem.
Apple back to 205 or just thereabouts. Facebook's getting a boost.
Right.
You like those big, the high growth, the FANGs, or are they too dangerous here?
No, well, listen, I like some of them, right? I don't use Facebook. I've never been a Facebook fan, so knock that one out. But names like Apple are names that I think in any portfolio deserve a position in your portfolio. But if you're a long-term investor, you just ride it out. But you can't listen to the noise, because on days like we've had in the last couple, those are the first names to get beaten up, partly because they're big names. Everybody's in it. It's the overweighted trade. So when everyone gets nervous, everyone runs to the door. As the long-term investor, the last thing you should do is run right out the door on names like that as an individual.
Let's point out, too, that GE is getting about half of its losses back this morning. That stock looks to me to be up about 6%, whereas yesterday it suffered its biggest losses in about 11 years.
Right.
What do you make of that story?
Well, listen, we could talk all day long about what I think about that story. I think the whole thing stinks. I think it just stinks, right? It smells. Partly because Harry Markopoulos partners up with this undisclosed hedge fund, does all this work, gives them the report the day before or 2 days before they make it public, and then is going to share in any of the profits. Doesn't that stink to anybody? Doesn't that scream something's wrong with this picture to anybody at all?
Reputable guy. I mean, we don't soil him.
Okay, he might be a reputable guy, but the fact is, he does his work. He partners up with you. He's going to benefit on a trade that you do on information that the public doesn't know yet. I'm going to give it to you first, and then we'll let the public know. I don't know. To me, that screams like...
Doesn't say anything about his analysis, though.
No, it doesn't say anything about his analysis, but it talks to, in my mind, it talks to character, right? But it doesn't say anything about the analysis. You're right, and I haven't looked at the analysis. And there's one thing between fraudulent accounting and aggressive accounting. We could talk about that all day long. But look, it's GE. I have trouble thinking it's fraudulent. I just have trouble. I could be way wrong, but...
What about the industrials in general? More cyclical plays. If you think that the U.S. economy's good, but you're worried about globally...
Yeah, but listen, so again, you have to be specific. You may not buy them in a swath across the board. It's like anything, right? You do your homework and you buy names that are going to benefit. Either going to benefit from the U.S. economy or they're going to benefit. You have to look past the economic cycle. Because look, here's the other thing that, has been driving me crazy the last couple of days. Everyone's talking about the pending recession. Look, we're going to get a recession. And the Dow's going to trade at 30,000 one day, right? It's going to happen. We know that. It's just part of the economic cycle. So the recession is coming. You set yourself up. It's not coming tomorrow. It's not knocking on the door. It's not here right now. It might be 15 or 16 months out, but you just set yourself up as you see. It's very dynamic. It's not static.
The Journal's got a piece that the White House president goes back to work on Monday, and that they are going to hold a call on Tuesday with state and local officials, with Kudlow, about the economy. And then we got Jackson Hole. So
Right.
I'm just saying, what are the likelihood of catalysts that spur buyers next week?
Listen, I think you're going to get Kudlow out. They're all going to talk about how great the economy is. Trump did it yesterday, the day before. Walmart earnings are great. Look how great we're doing. It's all good. I think we all agree that the U.S. macro data is not falling off the cliff, right? We think that the U.S. economy is okay. But I think the trouble is going to be the narrative around the world has been so negative with whether it's the latest Chinese numbers, the latest German numbers, the Eurozone, GDP going negative now. That's certainly not a positive story, but it's also not the end of the world at the moment, and the ECB is set. I think he's going to threw it straight into Christine Lagarde's lap to deal with about the next move that the ECB is going to make. But I think, like anything, you have to do your homework, and you have to pick stocks that you think are going to benefit in our environment.
Can the market get to a point or a place where it can just tell that story to itself? U.S. economy's good, the Fed has its back, or is it still going to be consumed with every headline or tweet about trade?
So here's what I think about that. I think the human beings in this industry can see the much bigger picture. I think the problem comes with the smart logic algorithms that read headlines and they read words, and they read positive words and they read negative words, and then create that cascade effect, whether it's on the downside or the upside. So I think what ends up happening with that is that the human trader kind of takes it all and looks at the broader picture. The algos yet have been unable to really interpret the meaning of a conversation. And even though the word might be negative, there really might be a positive story in there that it doesn't see yet.
You're raising the worry that some have, and that is, in the last crisis, we didn't have the machines at this level.
That's correct.
We don't know how much it'll change because of it.
That's correct. But what we do have, we have the circuit breakers. So if the market really starts to melt down, you have the circuit breakers that are going to say, wait, full stop, everybody take a breath, what's happening, right? So that is what we do have. But you're right, we did not have the advanced technology and algorithms in 2007 that we have today.
We making too much of the inverted yield curve, whereas people like Bullard are out there saying, look, for a prolonged period of time, then it's a problem. But what we had...
Listen, what did it invert for all of 3 minutes on Monday or whatever day it inverted? Okay, maybe it was 5 minutes. But yes, I think you're making... I think not you. I think the country is making, or the people that are talking are making way too much of that very small inversion.
Well, I mean, the market did go down 800 points.
Well,
Dow did.
I hear you, but because everyone's going, oh my God, it inverted, the recession's coming 15 months from now, so let's sell everything now. That's almost ridiculous.
Well, what about negative real rates? What about the 30-year at 2? I mean, it's not just the curve.
No, but look what's happening. People are searching for yield, so they're coming to the United States. They're buying our money, our bonds and our treasuries, and so that's forcing the yield to go lower. But one way or the other, do I think we're going to zero? I don't think the United States is going negative. Are we going to get close to zero? I would imagine probably if this keeps going. But I also think that people have to start to recognize and put in place, and I think it's actually happening. Because notice, that day that the market was down 800 points, there wasn't this sense of panic at all. People were just sitting there going, yeah, okay, it's another one of these computer-driven sell-offs. And look what's happened.
You did have, the nightly newscasts in mainstream television leading their shows, or the second story in with explaining a yield curve inversion to the mass.
Right, which I think was honestly really a waste of time to try to explain that whole yield curve inversion to just the masses, because I don't think the masses really care. I think the masses really care about what's the state of the economy, how do we set ourselves up for whatever's coming. They don't really care did the yield curve invert for 30 seconds. It makes no difference to the average American, right? Does it? That makes no difference.
Well, they care if there's going to be a recession.
It makes sense to the bond market, but for the average investor that's out there, they're about busy. They're out doing their work. They're running their businesses. Are they really
So is the bond market going to come back and say, my bad? We got this wrong?
No, I don't think the bond market's going to come back and say we got it wrong. But look, it's the investors in the bond market that are buying all our treasuries, that are forcing the bond market lower, right, in anticipation of what they think is going to be tougher times ahead. And we're going to get a recession. Absolutely, we're going to get it. When are we going to get it? I have no idea. But when it's coming.
I want to show the Dow's Wild Week again. We made this wall, and as I ask you this next question, is this how it's going to be? Volatility, the level of which we experienced this week, down 380, up 373, down 8, up 1. Who knows what today holds?
I think it's going to be like that through the end of August, just because go back to all the damage that the market's had. And so you got this thrashing around until the market kind of stabilizes and finds that level. So, yeah, I think the volatility will continue. I think you're going to see days like that. And you're specifically going to see days like that as he keeps tweeting. Trump keeps tweeting, whatever it is. And the next time China, that's why I'm worried about today, because you're coming into a weekend, right? So a lot can happen on Saturday and Sunday coming out of China. You could get, like we did on Monday 2 weeks ago, when they devalued the yuan, the market got slammed. The same thing could happen on Sunday night into Monday morning. China comes out with this retaliatory effort, which they've already threatened they're going to do. So what's it going to be? No one really knows, but that's why I'd be a little bit more cautious going into the end of the day today.
The boom and bang. Watch out for the boom and bang.
Just because I would tend to play, that's just my personality. I tend to play cautious.
It's been great hanging with you.
KP, that was the best 13 minutes of the week. Thank you. Good seeing you. So we're up 169. Dominic Chu's working the floor for us today. Hey, Dom.
We got right now is a situation, Carl, where we are still on pace, even with today's gains, to show you a market that is on track for its third straight week of losses. As you take a look at the Dow Industrials, the S&P 500, and NASDAQ, we are still higher on the day, but remember, we started off a little bit higher. We'll see if that kind of momentum can continue into the later part of this morning. If you take this in context over the course of the S&P 500 in the last year, one of the things that you'll notice is that we are still trying to get back to some levels that some traders are looking at significant. If you look at the S&P 500 over that time, the Dow, the S&P, and the NASDAQ on a one-week basis, still moving lower to the downside on that one-week basis. However, with the S&P 500 overall, we're still within about 5% or so away from record highs. So let's take a look at this because, remember, just here, just a few weeks back, right here we'll show you, it was at record high. And then if you take a look at where we stand now, that move lower is about 5% from those levels here. We are still going to keep a close eye on what's happening up here. 2944 on the S&P 500 is going to be an area to watch. That's the 50-day moving average, the more medium-term trend line for the overall markets. As we talk about maybe some of the sectors involved, places that we're going to watch with regard to what's happened in the market narrative as of late. If you go all the way back in August, remember the Fed rate decision at the end of July, since then, we've seen a decided move towards interest rate sensitive sectors. Real estate investment trusts right now up 3% just so far this month to date. You put in consumer staples and utilities in that mix as well. More defensive, higher dividend paying type sectors are the ones leading the way higher. Meanwhile, financials, we talk about the yield curve. That's been playing out a lot in those bank stocks. As the yield curve starts to flatten out and possibly invert, those bank stocks have taken a huge hit. And then energy stocks as well on global growth concerns. Down 11% just so far this month. Those sectors are key focus as well. On the stock side of things, mega cap, technology, communication services, and media stocks have been some of the places investors have been buying on the dips a little bit more aggressively so far this week. If you take a look at this week overall, still though, Facebook down 2%, Amazon down 1%, Apple though, here, a China issue perhaps there, playing out more in the Apple shares, and Netflix down 3% and Alphabet down about 1%. Those FANG stocks will continue to be a focus for traders as they see whether or not sentiment returns there. And then we'll end here on an overall check right now of what's happening in certain other parts of the market. The S&P 500 large caps, on a one-year basis, still handily outperforming the Russell. What we are going to watch right here is this underperformance by small caps. Will it start to exacerbate? That gap between small and large cap stocks has been getting wider as of late. We'll see if that continues today. It may be a risk gauge or risk sentiment or risk barometer for the overall market. So those small cap stocks still, Scott Wapner, a huge focus for traders today. I'll send things back over.
All right, Dom, we appreciate it. That's Dom Chu on the floor for us. Let's go now to Chicago, the bond pits. That's where Rick Santelli is at the CME Group. Hey, Rick.
Thanks, Scott. Historic week, of course, in treasuries, but maybe a more historic week if you look at global rates or the dollar index. Look at a 1 week of 2-year note yields. You know, they're unchanged on the day. Doesn't sound too scary. Down 15 basis points on the week. 1 week of 10-year. Definitely drifting, not quite on the lowest yields, but not far. Remember, 136, the yield from 2012 and 2016. That represents historic double bottom closes, lowest in history. 1 week there, down 20 basis points. And by the way, 30-year bonds, they sit at 2%, down 26 basis points on the week. But let's really look at the epicenter. Let's look at the shots, the 2-year in Europe. There's a 20-year chart hovering around minus 90 basis points. 1 week of the euro versus the dollar gives you a glimpse of a currency whose central bank takes easing to a new dimension. Its 1 week is definitely drifting lower. And we know the dollar index is hovering just within a quarter cent of fresh 27-month highs going back to May 2017. Well, here's the mirror image. The euro lows against the dollar. You guessed it, lowest level since May of 2017. Scott, back to you.
Rick, I appreciate it very much. Thank you. For more on today's movers, let's go to Bertha Coombs at the NASDAQ, and it's an NVIDIA day. Bertha?
It really is, Scott. It's setting a very positive tone in terms of chips. And this morning at the open, it looked like chips were actually going to be positive for the week. NVIDIA with a beat and a raise. That is moving up the rest. But we've got a little bit of a drag in that space in the chip equipment sector. Applied Materials, despite beating and maintaining its outlook, had a more muted tone towards whether we are starting to see a bottom and we'll see a pickup in demand. So the chip equipment makers are getting dragged a little bit there by Applied Materials. As far as this week, most of the sectors, as along with the NASDAQ itself, on pace for the third straight weekly loss. We're going to watch chips to see whether or not they will end up even on the day. Software, lower communications, hardware, though, set to snap a 3-week losing streak. Part of the reason there is that Apple, among the only FANG stocks and the only mega caps that is actually up for the week. And one thing to note, Scott, we did see the Russell 2000 this morning veering near the June lows. Most of the indices have managed to hold last week's lows. Russell was near the June low, but bounced from there. Still going to be down for the week, but a little bit of a positive silver lining on that. Back to you.
All right, Bertha, thank you very much. Bertha Coombs. We're up 156 on the Dow. A month to date, Dow's down about 4.8%, 4.5% for the S&P. We'll see how this Friday goes as we try to unwind some of the losses for this third consecutive week. Back in a minute.
The Bond Report.
This is a plug. A plug for the future. Inviting you to join the forward-thinking riders, skaters, and drivers who choose electricity to get around. Charging their bikes, boards, and cars using power from EDF Energy, the UK's largest producer of low-carbon electricity. So, do you like the sound of the electric future? Come and join us. Generation Electric. Everyone's welcome. EDF Energy.
It had been 22 years since Dan and Tom last met. Since they shared a desk in maths and played football together at lunchtime. 22 years with nothing more than a few Christmas cards and an online friend request to show for it. A 21st century eulogy for the loss of a once great friendship. Until a chance meeting outside the corner shop. On a morning they both decided to ditch the car and walk instead. Walk, cycle, discover. To the Mayor of London and TfL, every journey matters.
If your old faithful fridge freezer is broken or on the blink again, relax. At AO, we have a huge range jam-packed with the latest technology to keep your weekly favourites fresher than ever. Plus, there's great deals on top brands like Hisense, LG and Whirlpool, with finance options available. AO.com, the online electrical store. AO! Let's go! Credit is subject to status, must be over 18. AO Retail Limited is a broker and not a lender. Credit is provided by Secure Trust Bank PLC, trading as V12 Retail Finance.
The smell of freshly cut grass. The clean, crisp air of the seaside. Summer is here, so make sure you can enjoy it in all its aromatic glory. You can now get an air conditioning refresh, summer health check, and wash and vacuum for your BMW for just $49.99. Book online or visit your preferred retailer. Participating BMW retailers only. Health check contents may vary, subject to availability. Offer ends 30th of September 2019.
Primed for painting this bank holiday? Get to B&Q. With our huge range of quality paints, you can do it on Sunday and enjoy it Monday. Need some inspiration? For 7 do-it-in-a-day paint project ideas, visit DIY.com. You can do it when you B&Q it.
We spoke to the Cans from Sly about what BT's new complete Wi-Fi brings to their busy house.
Now the Wi-Fi literally does reach every corner of the house. We have 11 people that all use the Wi-Fi for different things, and the Wi-Fi disc has helped that so much.
The harmony in the house has improved 10 or 20-fold.
The Cans are 11 more happy BT customers with complete Wi-Fi that guarantees a Wi-Fi signal in every room.
Up to 3 discs to guarantee Wi-Fi or £20 off your bill. Terms apply.
Take a look at the Dow's biggest laggards of the week so far. Cisco down 10, followed by Dow, Chevron, UTX, and Walgreens. Walmart actually leading the Dow for the week. And the Dow is up 156. We're back in a minute.
Whether your politics swing right, left, up, or down, the road to 2020 runs through TuneIn. Get every angle of the 2020 presidential race with complete coverage from the campaign trail on TuneIn.
Hey, baseball fans. Can't watch the game? Can't be there? You can hear the home and away call for every team and every game with TuneIn.
Again, the 3-2, swinging a line drive up the middle, base hit. 1 run scores. 2 runs will score.
The app that brings together all the live sports, music, news, and podcasts you love in one place. Listen to every MLB game live as it happens or on demand with TuneIn Premium. Anytime, anywhere, all season long.
On the new podcast, Land of the Giants, Fox examines the ways today's biggest tech companies have changed our lives. We sat down and asked Jason Del Rey about the making of his new show.
My favorite part about making Land of the Giants is being able to step out of the day-to-day reporting grind and take a big view of the huge impact that Amazon's having on all of our lives.
Search and start listening to the podcast Land of the Giants on TuneIn today.
The NFL is back on TuneIn.
Throws the ball backside of the end zone, deflected and caught. Touchdown.
With the NFL on TuneIn Premium, hear the home call of every game live all season long. The show begins throughout the month of August with live coverage of every preseason matchup on the schedule. Then, as training camps come to a close, be sure to mark your calendars for NFL Kickoff Weekend, featuring the Green Bay Packers at the Chicago Bears on September 5th. At home or on the go, hear every game of your NFL team on TuneIn Premium. Upgrade today.
Summer is officially on. Now let's rock.
Check out TuneIn's music channels like Classic Rock Hits to relive the greatest rock songs from the 70s and 80s. Discover the biggest tunes from artists like Santana,
Got a black magic woman.
Pink Floyd, The Beatles, Guns N' Roses, and many more on Classic Rock Hits.
Search Classic Rock on your TuneIn app to start listening.
The summer's over, the lunches are packed, and the kids are back off to school. With so much free time on your hands, fill the void with the amazing audio on TuneIn Premium. Whether you want to dance around the house to the best commercial-free music or catch up on the world with commercial-free news from MSNBC, CNBC, and Fox News Talk. Plus, TuneIn Premium gives you every NFL, MLB, NHL, and NBA game and all your favorite podcasts. You're bound to learn a thing or two yourself with TuneIn Premium. Upgrade today.
On Beyond Meat this morning, topped out at 239 in late July, is now below the 200-day for really only the second time since May at 140. What a torrential story that was on the upside, and now perhaps on the downside.
Yeah, I mean, people were saying, beyond insane on the way up, and I don't know where it's going to settle on the way down. I was also thinking as you were, telling the folks back at headquarters you wanted to talk about this, I was thinking also about WeWork, this week, and to see what this market environment means for them as they try and go public when they, gave the S1, revealed this massive loss. You're talking about an uncertain environment, and I just wonder how that's going to be received. It may be far different than Beyond Meat was initially received.
We don't know, but the reviews of the S1 have been like something we haven't seen in recent history.
Yeah, no doubt.
Mixed at best. When we come back, Pulitzer Prize winning columnist Jim Stewart of the New York Times will get his reaction to GE being accused of accounting fraud. Of course, Jim's had his plate full with a number of topics in recent weeks. Dow's up 148.
Severe storm damage can cost...
Hemorrhoids. You talk to your GP, but you don't really get anywhere. Because the NHS has limited surgery for hemorrhoids, so you go on suffering in silence. Okay, maybe not so silent. It's time to speak to Xroid. They specialise in a new, fast, safe and effective procedure for hemorrhoids with no downtime. And the procedure takes just 30 minutes or less. Don't be one of the 8 million people in the UK suffering in almost silence. Get back to what you love doing. Xroid. Be kind to your behind. For free advice on hemorrhoids, text KIND to 81156.
Did you know Currys PC World do business? Saving your business up to 30% with mega deals on computers and printers, electricals, large screen TVs, and even more. Top brands like HP, Microsoft, Epson, Sony. And if you find it cheaper from any major retailer, we'll match it. Get these deals before they're gone. Must end soon. Visit your nearest store or pcworldbusiness.co.uk/megadeals. T's and C's apply. Excludes Inc. and third-party sellers. Visit website for price promise details. Claim within 7 days.
This is a plug. A plug for the future. Inviting you to join the forward-thinking riders, skaters, and drivers who choose electricity to get around. Charging their bikes, boards, and cars using power from EDF Energy, the UK's largest producer of low-carbon electricity. So, do you like the sound of the electric future? Come and join us. Generation Electric. Everyone's welcome. EDF Energy.
The whole family will have fun exploring much more than history at the Hampton Court Palace Food Festival this August bank holiday. Discover hand-picked produce and the tastiest street food, along with pop-up bars and restaurants serving cuisine from all around the world. There's cookery shows, talks and book signings by chefs and experts, along with live music and children's entertainment in the Palace Gardens. Hampton Court Palace Food Festival, August bank holiday weekend. Come on, give your taste buds a treat this bank holiday.
The sun gently fell below the horizon. Rays of pure gold filled the sky, illuminating the towering structures of the London skyline. What else could Jane do but gaze in awe? She was but a silhouette upon a hill, wrapped up in a spectacle so perfect. No words, oil paintings, or smartphone filters could do it justice. She savoured it. Before hopping back on her bike and riding off, she had to finish her commute home. Walk, cycle, discover. To the Mayor of London and TfL, every journey matters.
Good Friday morning. Welcome back to Squawk on the Street. I'm Carl Quintanilla with Morgan Brennan and Scott Wapner of the New York Stock Exchange. Sarah Eisen and David Faber have the morning off. Markets obviously laboring to get a bounce here to close out the week, although we are going to end the week likely with a weekly loss. Dow up 144, just off of session highs. We're going to get some economic data here in a moment. We had housing starts earlier today. Now it's time for you, Mish. Let's get to Rick Santelli at the CME in Chicago. Good morning, Rick.
Good morning, Carl. Yeah, you know, traders like this number, University of Michigan. Of course, this is a preliminary read, and it's a disappointment, 92.1. We're expecting 97, maybe a bit higher. Sequentially, our last final read for July was 98.4. 92.1 is the second lightest number of the year. The first being January, that was 91.2. So it isn't horrible, but if you go back a couple of months, especially towards May, we're at 100. Anything triple digits is quite impressive. So a bit of a slip there. Real quickly, I always like to look at the one-year inflation outlook, 2.7. 1/10 hotter. 1/10 hotter. That's interesting. And if you look at the 5 to 10 year, also 1/10 hotter from 2.5 to 2.6. Obviously, these people didn't listen to the last Fed meeting. Morgan, back to you.
But you did, Rick Santelli. Thank you. Our roadmap starts with the volatile week coming to an end. What a week it's been. Is today's optimism here to stay, or is a recession actually in sight?
GE rebounding a bit after suffering its worst day in a decade yesterday. We're going to talk about that with New York Times Pulitzer Prize winner Jim Stewart.
And later, we'll take you live to Hong Kong as protests continue to impact the Chinese markets and the economy there. U.S. stocks are higher today, rounding out what has been a very volatile trading week where we saw the Dow drop by 800 points in a single day. That's the biggest point drop of the year. The sell-off prompted by investor worries over an impending recession. Bridgewater founder Ray Dalio spoke about recession risks in an exclusive interview with CNBC. Here's what he had to say.
Recessions are always inevitable. The only question is when. And I think that...
Do you see one coming?
Yeah, I think that in the next 2 years, let's say prior to the next election, there's probably a 40% chance of a recession. And I think that you're seeing this around the world.
Well, joining us now, Stephen Whiting. He's Citi Private Bank Chief Investment Strategist and Chief Economist. Also with us, Brent Schutte, Northwestern Mutual Wealth Management Chief Investment Strategist. It's good to have both of you here. So, Stephen, Dalio's talking about the probability of recession. How should we be thinking about where we are right now?
Well, look, I think recession probability models are going to look like 40, 50%. They're going to look like a concern. The question is, do we do anything about it? And when you have low inflation, good consumer balance sheets, you obviously are facing this risk of production declines, trade declines, investment declines. But if demand can be cushioned, if it can be protected, I think much like the late 1990s, the 1998 example, you can extend a recovery with Fed easing right now.
Yeah, Brent, are we going to be obsessed with this recession fear story for the weeks that are ahead? Or can we get past it by saying that, you know what, the U.S. data has been good?
I think the only way we get past the obsession is if the trade war kind of calms down a bit again. So that seems to be the back and forth that drives this recession fear. It drives the yield curve. It drives this push to safe assets, which people continue to say is a reflection of a potential recession, which I disagree with a bit. But that's what the big variable is, and that's the only reason that we see to have a recession is that the trade war intensifies so much that it overrides all the other good things, Fed easing, things like that Stephen mentioned out there.
I agree completely, by the way.
And just to that point, Stephen, I mean, we have continue to have a strong consumer here in the U.S. We just got that sentiment number. It was certainly softer than expected. But I wonder, how much weight can we actually put into the modeling for recessions, A, and B, given that fact with all the headlines and all the reporting out there about increased rising risks of recession, do we run the risk of actually putting ourselves into recession because consumers get scared?
Well, look, I think this is exactly it. The idea that there's a silver bullet, a roadmap that we can all now follow together to know exactly how to time markets and figure out exactly what to do with portfolios, I think that will be a mistake. That recession timing and dealing with this in financial markets is going to be confounding. It won't be as simple as this little trigger. I mean, if the 1 3/4 year yield, was above the 10-year yield last week, then we need to react to that. So I think there's all of those overwrought concerns there, exactly. But I just be a little bit careful. When unemployment is at its lowest, that is when you get to the top of the economy. That is when you have recessions. I think that the financial impact of the trade war, again, is marginally driving declines in profits for important cyclical companies. It's what is driving monetary policy. So at the margin, this uncertainty is the most significant risk.
Brent, the list of things that are down year on year, rail car loads, lumber production, coal production, corrugated paper. I mean, does a full trade truce between the U.S. and China get those numbers back in the black?
Yes, because I think it's a bifurcated economy. I mean, the services side has done very well. You mentioned retail sales in the prior segment. The services side still looks good. The side that doesn't is the manufacturing side, and that points the finger squarely at the trade war and the uncertainty that is emanating from it. And so I do think that if you do get a trade war truce, which I think is in the president's best interest, and I think he knows that, and he'll only push as far as he can without tipping the U.S. economy into a recession, if you get that truce, I would expect the economy would re-strengthen. And the one thing I want to note is the only models that point to a recession right now are the ones that are being dictated by the yield curve. That's it. I don't really see any other models that are pointing to a recession risk yet. And the yield curve, to me, has artificial tendencies to it.
Stephen, that is a key point about a bifurcated economy right now. Right. And it makes me actually think about 2014, 2015, when you saw the commodity complex collapse, when you saw what happened with Chinese currency during that time period as well. Does this feel similar to you?
Well, you also saw a larger stock market declines.
Yep.
So again, this is a little bit of, what you think about in terms of asset allocation at risk. You're further on in a cycle. But exactly that gap, that the demand side of economies pretty much everywhere are holding in. And if that can be maintained, which takes some effort while you take down cyclical parts of the economy, we've got to remember that there are multipliers here, that if China's economy slows, their suppliers will slow, that there are effects of the two largest economies in the world, and some of these things are in train right now. Whether they worsen or not, again, could change the regime from growth to contraction. I do think that, again, away from just the yield curve, that we have the ability, again, to keep that in an expansion mode.
Yeah, well, that's the job, Brent, of the Fed, and that's going to be the focus next week at Jackson Hole. Is the Fed up to the challenge, so to speak? And are they going to be in a now prolonged rate cut cycle, which is going to be stimulative to the market and the economy?
I do think the Fed's up to the challenge. I mean, they've moved completely from the Fed that you used to know, which was about fighting inflation, to one that is now about enhancing inflation. And so the one thing I hope they do is follow the research that suggests that you go hard and you go fast when times like these occur, because I do believe July was 25 basis points wasted. Now, one could argue that was because the trade war amplified afterwards, but on the day they cut 25 basis points, the yield curve did not re-steepen. I think they need to convince people like me that they are serious about fighting deflation and that they are willing to throw caution into the wind and cut 50 to 75 basis points, even when inflation is not that low and the unemployment rate is not that high.
That's the Tom Lee playbook this morning. Go big or go home. I mean, he wants like a surprise cut, 75 basis points.
Yeah, now it's a little bit harder
September.
to surprise. And, look, I have been more of the view that the Federal Reserve will follow markets. That Powell's guidance at that press conference, which, again, it has nuanced and it would have been a lot simpler to not have a press conference, but was that we do not know what will happen on trade policy. We are not going to preempt and say, well, let's just assume there's a recession. So how would we treat that? And let's hope that there isn't one, right? That's not the Federal Reserve that we have right now. I still think that they can be relatively effective. And again, 9 central banks, aside from the ECB, aside from the Fed. So people are worried about that, but it would be much, much worse if central banks were not reacting to these risks. So if you want to worry about, yields being low, you could worry about them if they were higher.
Yeah, for sure. Thank you very much, gentlemen, to you both, Stephen and Brent.
Well, the Fed expected to make another rate cut in September, but with fears of a looming recession, will the Fed look to act even more aggressively? This is the question we keep asking. Steve Leisman joins us now with more, and he's been digging through all of this. Hey, Steve.
I wish I had a more definitive answer, Mona, but Morgan, but the Fed, like investors, struggling to process a series of cross currents in the U.S. and global economies that lead to different conclusions about where to set interest rates. Take a look at some of these cross currents. We have the weak global growth you guys were talking about, but U.S. forecasts remain for, about 2% growth. Bond yields, they suggest a recession in coming months, but U.S. economic data says otherwise. Finally, the consumer thriving while the manufacturing, both globally and in the U.S., may already be in recession.
The U.S. economy is actually in pretty good shape. We're not an island, though, and there's no doubt that as economies in Europe and Asia slow down and go into recession, we can't completely avoid that. But at the moment, I don't see a recession in the imminent future.
All right, here's how the market is pricing the outlook for the funds rate. Unclear if this is more aggressive than the Fed itself thinks where it's going to be. September, 100% chance of a rate cut. We'll talk more about that in a second. 82% chance of another quarter point in October. 56% chance of another quarter point in December, according to the CME. So 75 basis points of rate cuts built in by the market before year end. But now let's look at September, where this idea of being a little more aggressive, a 72% chance of a 25 basis point rate cut and a 28% chance of a 50. That number or that percentage has oscillated between, say, 25 and even as high as 40 in terms of where it is. There's some speculation the Fed could be more aggressive as soon as September. We'll see about that. Now, we'll get a better look. Rick Reeder from BlackRock said this morning that the Fed needs to go 50 because at low rates, each cut has less impact. Fed Chairman Jay Powell made pretty clear that he takes market pricing into account. The recent inversion of the yield curve, brief though it was, will work into his outlook, but so will the strong economic data. And we're going to get a better feel, Morgan, for the Fed's outlook next week in our coverage live from Jacksonville, Wyoming. Got to tune in to CNBC. We're going to have several very special guests. The annual gathering in the mountains taking on more importance now, I'd say, Morgan.
It absolutely is, Steve. And just to give us a little, a little preview here, what are you expecting to hear next week when you go out to Wyoming?
Well, I'm interested in a couple things. I mean, first of all, whether or not the Fed would act, in fact, too steep in the yield curve. I think they've talked about it as something that would keep them from doing things, but I never talked about an idea of actually moving to, say, doing some stuff on the longer end. I think that's one idea. Also, how seriously they take